and for what purpose we analyze these financial statements, and how can the analysis of financial statements really help investors, or how does the analysis of the financial statements help the creditors of the company or the lenders of the company, and who are the various other participants who are typically going to get benefited by looking at or evaluating the financial statements of the company. So, before we get into that, the financial statements are something which are regularly prepared, right? These are the statements which are regularly prepared by a public listed firm, by a public limited firm. They are regularly prepared, and they are shared for investors, creditors, etc., and various other stakeholders of the firm. These statements are regularly prepared by the firm and are shared with various stakeholders. Even a private limited firm also does prepare these financial statements, but the sharing may be only for a limited set of people. But if it is a public firm, it has to share these financial statements on a regular basis, let's say on a quarterly basis. These financial statements need to be prepared and they need to be presented to the various stakeholders. And that is what we are calling as financial reporting. It's a responsibility of the firm to show their performance, right? They don't comment on the performance. They try to showcase their performance to the various stakeholders by preparing the various financial statements. And what we see is these financial statements are more or less standardized in terms of format. They are prepared as per a few guidelines which are very stringently need to be followed. So this method where the companies prepare these financial statements and try to present that financial performance to the various stakeholders by preparing appropriate financial statements. Now, these financial statements are typically used by all these parties to make different kinds of decisions regarding either investing in that firm, buying the shares of that particular firm, or sell the shares of that particular firm, or extend loans, are probably short-term credit. Banks can really evaluate the short-term credit providing possibilities, long-term loan providing possibilities, or probably some parties can look at mergers or acquisitions of that particular firm. So these are the different kinds of decisions that can be made just by evaluating the financial statements to the core. So before I look at the financial statements, I need to have some kind of standardization in the financial statements, and that is what is being taken care of the financial reporting. It's a kind of a process which enables the companies to typically report their performance to the external stakeholders who will take some kind of decisions with respect to the investing, lending, and any other activities with respect to the company, right? So, this financial statements are a very key source of information for taking the decisions, and so past performance can be evaluated. The previous year's financial statements can be looked at. the past performance can be evaluated, the current numbers can be evaluated, and some kind of assessment about the future potential of the company can be arrived at. Future potential with respect to the profitability, with respect to cash flows, all these kinds of analysis can be done by evaluating the financial statements to the core. That's one of the prime reasons financial statement analysis becomes an utmost important task, and it is one of the buzzwords today. How well you are able to evaluate the financial performance of the company through the financial statements, right? Now, first of all, if that is the case, I need to know what are these financial statements, or what are the different inputs, what are the different inputs any financial analyst would be looking at to evaluate the performance of the company. As we said, financial statements are the key source of input to evaluate the performance of the company. So when I look at the financial statements, there are primarily four major financial statements that we will be looking at. There is something which talks about statement of financial position, right? There is one statement of financial position, sometimes typically called as the balance sheet. The older name for the same is a balance sheet. Now we started calling it as statements of financial position. Then we talk about statement of comprehensive income. This consists of two major statements. One is called as income statement. Sometimes people even call this income statement as profit and loss statement. And we see the other part of it is other comprehensive income. We'll talk about these. So that's one more statement that would be published by the company at a regular intervals of time and are revealed to all the general public if it is a public firm. Then we also talk about the statement of changes in equity. So how is the ownership changing? What are the different changes to the ownership related elements would be treated as a part of statement of changes in equity. And finally, we talk about cash flow statement. These are the four statements which we see would be published by the firms at regular intervals and are used by the analysts to draw so many conclusions about the performance of the firm. So as these statements are talking of statement of financial position, so at any point in time, so this is a mention about at a point in time. So probably it says as on 31st March 2014. As on 31st March 2014, that is how it starts. So on a particular day, as on a particular day, the company is having this much in the form of assets, this much in the form of liabilities, and this much in the form of owner's equity. These are the three broad level headings that are presented in the balance sheet. So when I'm talking about assets, which are talking about the resources which are owned and controlled by the firm. They need to be something which is owned as on that particular date and it is controlled by the firm, the worth of all those things. The company might be having a building, the company might be having a few vehicles as on that 31st March. The company might be having some machines and equipment. The company might be having some cash. The company might be having some raw materials. The company might having some people who still need to pay to the firm, who have purchased something on credit and who are still to pay. All these come under the assets of the firm, which are the different financial resources which are owned by the firm and which are controlled by the firm. We'll deal with all these things in detail as we move further, but just to understand on a broader aspect, the assets are those resources which are owned and controlled by the firm. The liabilities are those kind of resources which are owed by the firm to others. So the company, as on that date, the company may have to pay the loan back. It has taken a loan, so it has to repay the loan back. Or as on that particular date, it is still pending, it has some amounts pending towards payment to employees. Or it is still pending in terms of making payments to their vendors or suppliers. All those pendings are still owing to pay. They all get treated as a part of liabilities, and the difference between the assets and the liabilities of the firm is what will become the owner's equity. So this is what is a typical accounting equation. We always see this accounting equation goes like total assets of the firm should be equal to the total liabilities plus the owner's equity. This is a very important accounting equation that we need to be comfortable with. So we could very clearly see the distribution of the assets. There are so many subheadings that go under the assets, so many subheadings that go under the liabilities. So how each of these are composed and how do I evaluate by understanding the various elements of the financial statement is what is an essential step which with which we can assess the financial position of the firm at a particular point in time. But when we talk about the statement of comprehensive income, now I won't look at these two elements of the balance sheet at all. The owner's equity. So whatever are the changes that are coming to the owner's equity, whatever are the changes that are coming to the owner's equity except per shareholders transactions. When we say shareholders transactions, buying new shares or issuing new shares, buying back the existing shares, declaring dividends to the shareholders, those are all the shareholders transactions. All those shareholders transactions go directly into this statement of changes in the equity. But anything other than the shareholder based transactions, so when I say shareholder based transactions, anything to do with issuing new shares, retiring existing shares or buying back the shares, or paying dividend on the shares, those kind of direct transactions with the shareholders. So those things don't go as a part of statement of comprehensive income, they go as a statement of changes in the equity. Whereas here it's all other changes in the owner's equity except the shareholders transactions. And in this we see two major statements. One is the income